The Santa Barbara City Finance Committee meeting of September 30th, 2008. With me today is Council Member Schneider, and Council Member Falcone will be here shortly. And I also wanted to introduce my my new student intern, Rachel Garcia, who's sitting in the audience here, and she will be attending some meetings today to get an idea of how this city functions. So, Mr. Pearson, why don't you proceed with the investment report?
Thank you, Mr. Chair. Councilmember Schneider, my name is Bob Pearson, City Finance Director, and as you know, the only item on today's agenda is the monthly investment report, in this case for the month of August. And as you know, generally for the non-quarter end months, we don't have much of a prepared presentation, but I think that given the situation in the credit markets, I think we'll talk a little bit about that today. So I want to start with a look at our investment activity for the month of August, and I've got that up on the screen. You will note that the first in the upper left-hand corner, we talk about purchases or deposits, and you will note one thing in particular, which is that we did not purchase any investments in the month of August. Every one of those transactions is a deposit to the state of California's local agency investment fund, so there were no purchases. In terms of the bottom side of that, you see maturities, calls, and sales. And you see that with two exceptions, all of the activity there were withdrawals from LAIF. And as you know, LAIF is the state of California's money market fund, stands for Local Agency Investment Fund, a multi-billion-dollar fund that the state manages to, for its own overnight cash investment needs, money market, and makes it available to local governments as well. The only two other transactions that we had in the month was a maturity, one maturity, and one called security. And the maturity was a Wells Fargo debt, bond of Wells Fargo that matured on August 15th, and the other one was a call of a federal agency security. So those really, we were not in the market in August. In part, that was certainly due to the uncertainty in the marketplace, particularly as you recall with Fannie Mae and Freddie Mac. But all in all, I'm going to take this down because I don't have two copies. The other page I want to show you is the balances as of August 31st. You can see that as of the end of July, we had total cash and investments of $166 million. And then as of the end of August, a month later, we had total cash and investments of $159 million. So the net activity for the month of August was a decrease of about $7 million, which simply represents our cash flow needs for that month. That's all it really is. Just want to point out that that you can also see at the bottom half of this worksheet the percent of the portfolio in the different categories of investments, adding up, of course, to 100%. We had about 17% in LAIF, just one $2 million certificate of deposit, CD, in a local bank. We had about $4 million in Treasury securities, almost $99.5 million in federal agency securities, $17.2 million in corporate securities, and we had, as you well know, a $7.8 million promissory note from our own airport fund, which is due at the end of this calendar year. That really concludes my basic presentation. I'd be glad to answer any questions.
Could you just comment on the change in the average days to maturity, which is reflected on the right-hand column there?
Certainly. As of the end of July, as you can see, we were at 611 days, average days to maturity, and a month later that had dropped by 10 days to 601. Really, that is not a particularly material change, but it will, because we did not have any purchases during the month of August, what it really represents is the natural aging of the portfolio. That is, 30 days later, everything is 30 days closer to maturity since we hadn't purchased anything new. That's really just kind of the natural aging of the portfolio as it rolls closer on balance to maturity.
Would your thinking be to keep things a little more close to maturity, or?
Yes. We certainly at this point are not looking at going out any more than, say, 3 years. I know this is about August, but here we are basically at the end of September, and I'll sort of give you a preview of our September activity. We had not been in the market in September as well, basically for the first 3 weeks of September. And then just this last week, we did jump in and purchased about $6 million of federal agency securities because the spreads were just too hard to pass up. In other words, what we were getting on 6-month federal paper was well over 1% more than we are currently earning in the state LAIF fund. So it was just too hard to pass up with the fact that we could earn 1 more percent, a full percent, but that was a 6-month piece of paper. We also bought a couple others that were in the 2 to 2.5 to 3 year range. So it just doesn't make any sense to go any further out. The additional yield isn't there to warrant going out 4 to 5 years. As you may recall, we are only allowed to go out 5 years maximum under state law and our own investment policy unless the council approves otherwise in advance. So I would expect that, yes, we will pretty much maintain our existing days to maturity.
Bob, at this point, there's a great deal of interest in the community about the general financial situation in the country as a whole right now, and I have had a few calls and emails about the city situation. And since we are in Finance Committee today, I wonder if you could comment, just a few general comments on how the portfolio is established and some of the rules and regulations that we operate under, and some of your thoughts on this.
Certainly, Mr. Chair. Well, I'm going to start basically at the beginning, which is that the investment of public funds in the state of California is governed first and foremost under state law. There is a public investment code that sets forth what cities and counties can invest in and what they cannot invest in. In addition to that, the city has adopted its own investment policy, which is actually slightly more restrictive than state law is. So that's the framework within which we operate. We have well-established rules and regulations. As you know, each year the council, the Finance Committee, and the City Council review our investment policy and readopt it every year in conjunction with the start of a new fiscal year. And as I said, our investment policy is in several regards more restrictive than the state code allows. First and foremost, I can say that under state law and, of course, our own investment policy, we are not allowed to invest in stocks. So our investment portfolio is comprised entirely of bonds, and the vast majority of those bonds are federal government securities. You know, if you look at the August 31st investment report, basically almost 65% of our investment portfolio is invested in federal government securities. Now, those securities, particularly some of the federal agencies, we've heard the names Freddie Mac and Fannie Mae a lot recently, and we do own a fair number of Freddie Mac and Fannie Mae securities. And we had always bought them because the market, and including our finance department and our city, had always believed that that there was an implicit federal backing of these federal agency securities. Technically, they were not on the same level as direct federal treasury securities, but there was always the assumption in the marketplace that they had an implicit guarantee of the federal government. And the reason you would buy them as opposed to treasuries is because the difference was the federal treasury securities had a explicit or direct guarantee of the federal government. Federal agencies like Fannie Mae and Freddie Mac and the Federal Farm Credit and the Federal Home Loan Bank had implicit federal guarantees. And because of that difference, agency securities pay a higher rate of interest. And many people buy those agencies over treasuries because they do offer a higher rate of interest and because they still were assumed to have the implicit backing of the federal government. Well, of course, we know that with Fannie Mae and Freddie Mac now, with the federal government taking those two, they call them GSEs, government-sponsored enterprises, the federal government has now taken them over. And so that implicit guarantee that everyone assumed was in place has now indeed turned into an explicit guarantee. So the bonds that we own that were issued by Freddie Mac and Fannie Mae are now explicitly guaranteed by the federal government of the United States of America. And so there really is no credit concern on Fannie Mae and Freddie Mac bonds anymore. We do own several other. I mentioned the Federal Home Loan Bank. Most people have not heard that name in the news lately, and that's because they're not in trouble. And the same thing with the Federal Farm Credit Bank. We do own several of those pieces as well. But, you know, we are not allowed to invest in stocks, so we don't have to worry about what the Dow is doing or the NASDAQ is doing. We only invest in bonds, and primarily we invest only in government-issued debt. I do want to mention, even though we don't consider it technically an investment, we have the city banks with Santa Barbara Bank and Trust, and we have at any given time several $1 million in the bank. Now, everybody knows, well, most everybody knows that the FDIC, the Federal Deposit Insurance Corporation, insures depositors' bank deposits up to $100,000. Well, in some cases, if a depositor has more than $100,000 in a given bank, and there are exceptions, including retirement accounts and other things, but then the amount over $100,000 is not considered insured and technically is at risk in case of a bank failure. We're protected, however, because under the state government code, all public deposits in banks must be collateralized, and they must be collateralized at 110% minimum of the value of the public deposit. And let me explain that, if I might, what that means, what collateralization means. It means that if the city has $1 million in our checking account in Santa Barbara Bank and Trust, that Santa Barbara Bank and Trust must have $1.1 million of federal securities set aside in a trust account for our benefit. In case the bank should fail, we would then have the right to secure those federal securities and take them to represent a return of our deposits if the bank should fail. Now, I'm not suggesting Santa Barbara Bank and Trust is in any kind of danger. I don't mean it that way. I'm just trying to explain what the state code requires. And they do require, as I said, that it be at 110% of our deposit amount. So we even have a cushion in that regard. So even though our deposit may only be covered by the federal deposit insurance of up to $100,000, under state law, we actually have these federal securities that the bank is holding in trust for our benefit should anything happen to our deposits. So we're secured with our banking relationship as well as with our investments.
Ms. Snyder?
Well, I just first want to thank you for that explanation, and to take it one step further then, in terms of what does that mean to the average resident here in Santa Barbara, is that worst case scenario, if all banks decide to close, we have security in terms of keeping the city running day in and day out, that we're not going to lose the funds that we receive from taxpayers and rates and fees and all of that, and we'll be able to continue as an entity.
That's absolutely right.
Right. So just to translate that into English, because that's how I translate it. But I think that's important in terms of general security of the city as a whole, as it works on a daily basis and how it interacts with its residents. So I appreciate that clarification, given all the news going on yesterday and the past week.
Right. And one more thing I'd like to add is that the securities that the city owns, be they federal treasury securities or federal agency securities, are, to use the vernacular again, highly liquid, which means that on any given day, we would have no problem selling those securities, even with the market being what it is today. Now, what we could sell them for in terms of the price we could get for them depends on the interest rate that they're paying, or were paying and are paying at the time we bought them. But the fact is that we would have no problem converting any of our securities to cash at any time.
Great. With that, I'll move this to consent calendar.
I will second that, and we'll say all in favor.
Aye.
Aye. Motion carries, and unless there's further business, we'll adjourn the meeting. Thank you,
Thank you.
Mr. Pierce.